Today's call is how to read a financial statement to determine the income potential of the IRS collection potential. This is a really good topic because the income component of this kind of basis, when we're determining income, it's the basis of your entire case on whether the IRS is going to be able to collect on the client. And you see it in bright, bold red here. The future income calculation is where most tax practitioners actually go completely wrong when trying to help their taxpayers. So this component is really important to kind of determine how are we going to help the taxpayers, what resolution options that they have. And actually, I'm going to bring up, I forgot to bring this up, 433A, just for us to take a look at this really quick and where that's located. When we're doing IRS collections, typically they're having you fill out that 433A, and you're going to see in certain sections, you'll see right here under section 2, the employment information for the spouses. That is in here. But right down here, you're going to see right here on section 5, you see where it says all this information here. This is the income component. And obviously you're gonna see something here, gross monthly income, and I'm gonna talk about why that is so important. So this is the section that we're determining how to make sure we got the correct information in there, so the IRS can figure out how are they gonna collect on the debt that's owed to the client. One of the big examples I tend to see, big mistakes I see here is a lot of times when a tax practitioner is working with a client, that they will only use the taxpayer's income when determining the ability to pay back, their ability to pay back the IRS. But when the IRS is looking at this income information here, what they're determining, you see other income, they're determining is what is the total income coming into the house. The ability to pay the IRS is not based on what the taxable income to the taxpayer is. It's the cash flow that's coming from all sources into the home. Does anybody find that strange? So as an example, let's just say I'll use me as an example. When I didn't file my taxes, and then when I finally filed my taxes and had a huge, almost six-figure tax bill, when it was time for the IRS to determine the collection ability of that, even though it was my tax debt before I got married, because I was married and because I lived in the same house as my spouse, they would actually, I actually had to give them the income information that my spouse was making. Not because she owed the taxes, is because they're trying to determine what is the total income coming into the house that could potentially be used to pay the tax bill. You guys got that? And please feel free to talk and ask questions as we're going along, since it's only a couple of us here.
Yes, that makes sense.
Thank you. Thank you. So when calculating the taxpayer's ability to pay the IRS, they will utilize the gross monthly income and then allow certain allowable expenses. We're not going to talk about the allowable expenses, but let's talk about this gross monthly income. See, as I mentioned earlier, they're looking at gross monthly income coming in from all sources. So the thing that you have to be paying attention to when somebody comes to you that has a big tax bill, well, who lives in the house and who contributes to the household income? It may be a spouse. It may be roommates. One thing right now we're seeing a lot of households, mixed households, where there's multiple, whether it's roommates, two families in a household, grandparents in a household that are getting Social Security income. It might be children earning income in the household, whether it's younger children are earning income. I just met a 12-year-old recently that makes almost $20,000 a month on YouTube income. So you have to kind of calculate all this information, right? Are there adult children living in the house still? One thing that we've seen a lot over the last couple of years, we're going to see a lot of this as we go into future years because of the recession, potentially depression, whatever that's happening. As the economy gets tougher, there's going to be more and more people moving into the home to share expenses. So when we're trying to determine what's the income in the house, are there adult children living in the house that are helping pay for expenses? Anybody else living in the house that aren't relatives? They're just other members of the family, as other members, friends, family members that might be living there. So when it ultimately comes down that ability to pay the IRS wants to know what's all income coming into the house.
I have a quick question on that, on the children. From what I understand, there's like a law that you have to set up like a certain type of trust for the kid, because you're not supposed to use the money, because you know how some of these kids, their parents used up the money, the child stars.
Huh?
So
really?
This is something. Yeah, so this is something I heard. I don't know the details of it, but especially with child stars, it's like mandatory for them to have a certain type of trust.
Okay.
So the parents can only use a portion of that income. They're not allowed to touch it.
Oh, okay. And that might be the case, so let's just say we do have a case like that, and a parent, especially being in California, you might have, tax clients that are in the entertainment industry, or the kids are. Then, if we were dealing with the tax debt of the parents and there is income coming in, it's a child star, and they're using that income, and if there's a trust involved, then I would imagine there's legal lease in the paperwork that says the parents has access to X amount of dollars out of that trust. So that is something the IRS is going to want to know, and you would have to document that.
Especially because these YouTubers, it's growing more everywhere. I think it's something that like as a preparer, we should look into it. Well, if you're doing tax resolution, you should look into it to find out if that is the case, because I'm guessing it's more common. It's going to be more common now.
It's becoming more and more common. Yeah, no, absolutely. Just remember, you as a tax practitioner, you need to figure out what's that total income coming into the house. If you just remember that, and then if there is separate trusts that are involved, the IRS is going to want to know. Because I had a specific case where I had an adult, he was in his 50s. He recently divorced his wife, and he went and moved in with his parents. So he moved in with his parents to try to get back on his feet. He was trying to do an offer of compromise, and he was denied. And the reason he was denied, because when he submitted his offer of compromise, the IRS noticed the house, the address that he was living under was in a trust. It was, I'll just make up a name, Hernandez Family Trust. It wasn't his house, it was his parents' house. Well, the problem is he's got the same last name. So IRS thought he was trying to hide something, that he owned the house. And then once he actually explained to him, no, I don't own the house. It's not my trust, it's my parents' trust. The IRS said, well, why isn't your parents' income calculated into the total household income here? Gets complicated, right? So, and there's, and again, they're not using all the income, but what they actually do, because the parents didn't know the taxes, well, they just assume, well, if the parents are providing 25% of the income coming into the household, then, or 50% of the income, then he can't write off all the expenses in the household, right? Because his parents has 50% of would share, let's just say 50-50. He can only claim 50% of the expenses on his paperwork. We're not going to include the parents' income. We're just, we have to adjust the expenses that are being paid. So that's kind of why they need to know what this income is.
But what if he didn't move in because of a divorce? What if he moved in to take care of his parents because one of them was sick or elderly or whatever?
Same thing. They're going to want to know if they earn income. Do the parents have Social Security income? If they do have Social Security income, and let's just say there are three people in the house. There's the kid and, well, let's just use two. The kid and he's taking care of his mom. His mom has Social Security income. And let's just say that Social Security income is the equivalent of 20% of the income coming into the house. Well, they're gonna subtract 20% of the expenses because they would have to kind of share the expenses in the house. They're just not gonna allow you the full deduction on rent, on utilities, on food, things like that.